Very good morning, friends. So I hope your revisions are going good. The weather is pretty good, and I think we're also going to replicate the weather out here. A wonderful weather, and I think we're going to do a wonderful question. As promised to you, I am now going to do a comprehensive question on consolidation, which has got some wonderful adjustments, including the impact of deferred taxation as well. Now, since we're doing a consolidation question, I think it made sense that I take up a question which includes a subsidiary as well as an associate. The focus is in terms of doing a consolidated balance sheet question, which has got a couple of adjustments. Now, the idea of doing this particular question is to, revise and get the concepts clear. I think if you look at the size of the question, you may not get that kind of intensity questions in the exam. But as I said, the idea is that you get a good expertise on the different kind of adjustments, and therefore I selected this particular question, which is something new to you, and you get a flavor of how different kind of adjustments are handled. So it's going to take us a good time even in terms of reading this question, because this question actually is a pretty long question. If you consider on a marks wise basis, this could get almost a weightage of around 25 marks if it comes in the exam. The possibility, of course, is not there. So my disclaimer at the very start is that this question is something which is meant to just practice, open up the mind in terms of various adjustments. So don't get, scared on the size of the question, what we're going to do. So this question is also going to take us a good time to do. But I think, as I said, the idea is that we get more expertise in terms of each and every 7 steps which I've given you so that you can get a good grip on the concept. Post this particular question, we're going to do a question on the consolidated profit and loss as well, so we get exposure in terms of how a consolidated income statement is also handled. So I think let's begin the journey. I am first going to read the question with you. So let me, I think, first crop this question out. So wonderful question. And I guess let's, I think, first fit into this. Let me also zoom the second bit as well. So the question carries on in almost around 3 pages. So you can well imagine the kind of intensity the question has got. So we need to spend a good time reading, understanding this question as well. I think that fits in well. Let me zoom this part also. So let's, I think, begin first of all reading the inputs which are given in the question, and then we'll solve this question out. So I am first of all given Alpha is a parent company with investments in 2 companies, that is Beta as well as Gamma, and it is preparing its consolidated statement of financial position. That basically means a balance sheet. And we're also given the information in the notes to accounts as well. Now you can notice that in certain items we are given the notes, but we'll catch on these notes later. But I'm just trying to highlight that these are the notes which are given against the items in the balance sheet of the company. Okay, so I think this is apparently the balance sheet. There's nothing much to see on the balance sheet as of now. Let's, I think, take the journey forward and read the additional information. Now, in note number 2, I am given, it says on 1st April X0, Alpha acquired a total of 75 million shares in Beta, and this is by means of a share exchange. And the terms of the business combination is given. Alpha issued 2 shares for every 3 shares acquired in Beta. So Alpha is acquired shares in terms of Beta, and all this is being discharged by way of exchange ratio, shares exchange. And it tells you very clearly that 2 shares are issued for every 3 shares in Beta. Then I'm also given on 1st April X0, the market value of Alpha share is given to me 3.5. And I think that will require for the purpose of calculating the purchase consideration. Then he says Alpha will make a deferred cash payment to the former shareholders of Beta on 31st March X3. So this is a DC, a deferred consideration, which is going to be paid after a couple of years. That means at the end of X3 would mean X1, X2, X3, which means the payment is going to be made later. Then he says on 1st April X0, that is the date of acquisition, Alpha's incremental borrowing rate is given to me. It's 10%, which will be used for the purpose of calculating the present value of the deferred consideration. Then he says Alpha included a liability which is given in respect of the deferred payment in the statement of financial position. So we're given this figure, which is appearing at a figure which seems to be a present value. So I think we'll make a check on that. So I think so far we can see that in terms of the note number 2, I am given the information that the consideration, the purchase consideration, is paid in the form of shares as well as in the form of a deferred consideration. That's the two basic informations given. Let's read further. It says it is the group policy to value the NCI at the date of acquisition at a fair value, which means at a fair value, the goodwill is going to be a full goodwill. Then he says the market value of equity shares of beta on this date can be used for the purpose. So we are also given the market value of the share for the purpose of calculating the NCI because we're using a fair value method. So we'll take the number of shares into the fair value per share. Then he says on 1st April X0, the retained earnings of beta is also given. Then he says directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities of beta on 1st April X0. It seems that he started discussions on the fair value adjustments, and this is going to be impacting our step number 2A. That means we'll take the fair value adjustments in that case. And it says the following matters emerged. It says plant and equipment with a carrying amount of 100 million had an estimated market value of 110 million. The estimated future useful life of the plant is given to me 5 years, and this estimate remains valid. It says Beta disposed of 20% of this plant and equipment since 1st April X0. Now that becomes a new addition as well. Because generally you would have seen adjustments pertaining to fair value adjustments, but then it says that 20% of the asset is disposed of. How does it make a difference? I remember asking you in the previous class as well that if there is a fair value adjustments to the inventory and the inventory is sold, then how do you tackle that? Don't worry, I'm going to answer all that questions today with the help of this question. And then it says also about the inventory, that inventory is got a carrying amount of 35 million, which has got an estimated market value of 38, and the inventory is also sold since 1st April X0. Okay. Then it says the fair value adjustments have not been reflected in the individual financial statements of Beta. So we need to incorporate them for the purpose of consolidation. Then he says in the consolidated financial statements, the fair value adjustments will be regarded as temporary differences for the purposes of computing a deferred tax. Wow, that adds a little more flavor to the concept, because in this particular case, we are considering that any kind of differences which is going to arise because of the fair value, the carrying amount will become the fair value and the tax base is going to be the original book value. So this is going to lead to deferred tax implications, that is Ind AS 12. Wow. Then he says the rate of tax to apply to the temporary differences is also given 20%. And on 31st March, directors identified that the goodwill stands impaired by a certain figure. I'm pretty sure you must be feeling, very excited to look at this question. What do you say? This goes on the popular demand. So what do you say? I started off at a time, I think, when people didn't join. But I think since you've just joined in, let me just ask you, I hope the question is clearly visible and you're enjoying the kind of adjustments in this question.
Yes, sir.
Wonderful. Okay, so this, I think, just to give you a little brief in terms of things, I just, read the question so far. The question is still going on. So we are basically given the balance sheets of Alpha, which is the parent, the investor, and Beta, you're going to see, is the subsidiary, and Gamma is going to be the associate. Now, this question contains the concept of both the subsidiary and the associate company combined in the balance sheet status. We just went in through the additional information, and I am given the inputs that there has been some investments Alpha made in Beta, and then I am also given the information regarding the purchase consideration, which is in shares and which is in a deferred consideration. It yet to be seen that is this all this incorporated in the financials or not. We'll see. We'll take care of that. And then we're also given the status of the fair value adjustments in which plant and inventory is appearing. And there are some deferred tax adjustments related to that. And there is a goodwill impairment. So far, so good. This is one part of the adjustments. Let's have a read further. There's more to go. As I said, this could be almost like a 25 marker. I actually, took these questions from one of the examinations, which is held for IFRS diploma. And I thought it's a wonderful treat in terms of giving you all the insights of good adjustments. Because I think this contains some kind of adjustments which, we might not have even confronted much in the exam. So this is more like, budgeted kind of a question where you enjoy the treat. Sunday morning, good weather, replicating it in the class as well. Then there is an investment which is made in Gamma, and then it says on the date of incorporation of Gamma, Alpha subscribed for 40% shares in Gamma. So that means you've got a 40% stake, which means it is supposed to be an associate. Making a payment of 32 million in cash, and this investment is made as an associate. The draft financial statements of Gamma of Alpha recognizes this investment at cost, not as per the equity method, because if this is a case of an associate, then in the consolidated balance sheet, you need to reflect the investment as per the equity method of accounting. You can ignore any deferred tax implications on the investments by Alpha and Gamma. You already know that as per Ind AS 12, investments in the associate could also result in deferred tax implications, which could be, creating a deferred tax asset or liability. Because in those particular cases, there is a special considerations given. But I think he's made the life simple. He says, ignore the deferred tax implications on these investments when you will consider equity method. Then he says about intercompany sale of inventories. The inventories of Beta as well as Gamma included the components purchased from Alpha. So is this upstream or downstream in nature? Beta Gamma is the subsidiary as well as the associate, and they purchase the goods from Alpha. So is it upstream or downstream in nature? Undoubtedly downstream in nature, because Alpha made a sale to Beta and Gamma, so that is downstream.
It says here downstream.
That's right. And then we are given the cost at which it is sold. Alpha applies a markup of 25% on cost in arriving at the selling price of these components. So 1/4 on cost, 1/5 on sale. He again says you can ignore the deferred tax implications of any adjustments. Wonderful. So he's told us to ignore the deferred tax on the investment as well as on the intercompany sale transactions as well. Then comes another point on the long-term borrowings. It says the long-term borrowings of Alpha arose on 1st April X1 when the Alpha company borrowed a 50 million amount. Alpha incurred an issue cost, which is like a TC, and the exchange rate is given, that is $1.2, €1. Wow, that also makes it an element of financial instruments along with the concept of foreign exchange. So you've got the concept of Ind AS 109 and Ind AS 21 also blended in this question. Superb. And then it says on 1st April, Alpha included 80 million in long-term borrowings and charged 1.2 lakhs to the comprehensive income. The borrowing requires Alpha to make an annual interest payment in arrears. And then it says the average exchange rate is given and the closing rate is also given. Alpha therefore charged a finance cost of 5 million to the comprehensive income on 31st March. Comprehensive income means that he's talking of the income statement. The loan is repayable on 31st March X6 at an amount of, it says 59 million. The effective annual interest rate applicable is 11.1%. Other than that described in this note, Alpha made no other accounting entries relating to the loan. You can again ignore the deferred tax implications of any adjustments you make due to the information in this note. Use the draft financial statements of Alpha, Beta, Gamma on 31st March X2 in note number 1 and the further informations given in the note number 2 to 5 and make a consolidated statement of financial position on 31st March X2. Okay, so I think we've read the question, but we'll have to revisit again when we come to the adjustments. I've just done a plain vanilla reading, which means we've taken almost what? 15 minutes to read the question. What do you think how much time I'm going to take in order to solve this particular question? Any wild guess?
30 minutes.
Sorry?
30 minutes it will take.
It'll take me at least more than an hour's time to solve this particular question. Trust me, it's got so many adjustments. Even if this kind of question comes in the exam, it'll take you not less than 50 minutes to solve. I'm again giving the disclaimer, this kind of questions cannot come in the exam because we don't get a weightage of almost 25 marks. The idea is to expose you to adjustments. So there could be certain adjustments which you could confront in the exam. Otherwise, I think the idle time to me would be 50 minutes, but I need to explain things in between as well. So it would stretch more than a 1 hour. So we might almost reach the time of your break by the end of this question. Superb. Okay, so 3-page of question. I think now it's time to start the particular question. Trust me, whatever the intensity of the question is, I would always say that you need to apply the 7-step model. Keep your focus very clear that what do you need to organize. Now, considering in this particular question, we know that there is a subsidiary and there is an associate, and therefore we need to organize the information both from the subsidiary and the associate point of view. But I think in the first instance, I'll identify the percentages and date of acquisition. But moving forward in terms of the other steps, I'll take care of the subsidiary. The associate, I'll take care in a separate step. So what I'm going to do, I'm going to add another additional step in order to calculate my investment in the associate as per the equity method. So I'll just add another step. So before the step number 6, I'll add a step number 5A, calculating the investments in the associate equity method. So we're going to keep the 7 steps. Let's begin. So I am first going to start with my step number 1. Let us first of all organize the inputs in terms of the date of acquisition as well as the percentage. So we need to organize the percentage and the date of acquisition. So let's organize the data. And in this particular case, we need to consider 2 informations. One is Alpha, which is the parent company, is got shares in Beta, and Alpha, the parent company, is got shares in Gamma. So I'm organizing the status of Alpha in Beta as well as Alpha in Gamma. So let me just go back to the question and let me organize the data. So first of all, we can see very clearly in the note number 2, on 1st April X0, Alpha acquired 75 million shares. Let's come back. If you look at the balance sheet of Alpha, it has got a total of 1 lakh shares. This is all in terms of 1,000. This is all in terms of 1,000. So you need to be careful. You need to be careful that here it says 75 million shares. So, I've done the calculations, but you can just go carefully. When I say 75 million shares, can I say 1 million is 10 lakhs? So this works out at a total of 75 lakhs. So if you convert this figure in terms of thousands, it is going to come to, because 75 million and this figure is all in terms of 1,000. So
It will
please
come
convert
forward to
this.
second head.
I guess it comes to a total of, this is, I guess, a share which is $1 each. So I think it's 75,000 shares out of 1 lakh shares, right? So my percentage out here is going to be 75,000 shares acquired divided by 1 lakh shares. So the percentage in this case is 75%. And as far as the date of acquisition is concerned, I think it was 1st April X1, X0, I guess. So that was 1st April X0. That was the date of acquisition. Just to show you the inputs again, 1st April X0, 75 million shares. Now let's also go to the next company, that is Gamma. So it says on the date of incorporation, Alpha acquired 40% shares. So date of acquisition is not given, but I'm just given that this was acquired on the date of incorporation itself. The day when this company got incorporated, the shares were acquired, and we can write down date of incorporation and the percentage 40% clearly given. Now, let me, I think, say something more at this particular stage. Can I say if the shares are acquired on the date of incorporation, does this mean that all the profits are post-acquisition in nature? Because if you acquire the shares in the associate on the date when the company got incorporated, can I say all the profits earned is post-acquisition in nature? Correct?
Yes, sir. Yes, sir.
Absolutely correct. So let me, I think, just put this down that this means that all profits of associate is post-acquisition. The associate is post-acquisition in nature. So this is going to be post-acquisition profits in nature. Right, so my step number 1 gets well organized. Now comes the crucial step, and that is step number 2A, which is, I think, the best part in this question. Let's consider now the step number 2A, analysis of other equity. So I'm now going to focus only on the subsidiary. We're going to focus on the associate company later. As I said, I'm going to add a step number 5A, calculating the investments at a later stage. So let's focus only on the subsidiary. So let me first draw the inputs, or I guess let me just create a space here, and we can maybe extend this analysis on the right-hand side. So let me extend the analysis on the right-hand side itself. So that is my step number 2A, where we're looking at the analysis of other equity. So this is going to be pre-acquisition, that is 1st April X0. And this is post-acquisition, starting from the date of acquisition. And I guess the balance sheet date is March X2. That becomes post-acquisition. So here again, you can just make a mention pre as well as post-acquisition. Now, your focus needs to be very clear. I'm again reminding you that when you're doing a consolidated balance sheet question, you've got total of 3 focus points in the mind. Number 1, you need to consider the other equity in the balance sheet of the subsidiary. That's 1. Second, you need to consider the fair value adjustments in the additional information. Number 3, you need to consider any stock reserve which is downstream or upstream in nature. Now, in this particular case, the stock reserve is supposed to be downstream, so that doesn't bother me. So I think my focus is only in terms of 2 inputs. One is I need to consider the other equity in the balance sheet of the subsidiary. And the second is I need to consider the fair value adjustments, which is all given in the additional information, note number 2. So let's, I think, begin the analysis with the subsidiaries' other equity in the balance sheet. Now, let's be a little more careful on this end. So we can see that as far as the retained earnings of beta is concerned, it is appearing to the extent of 1 lakh. So this is the only thing which is appearing as other equity in the balance sheet. So we just need to take care of this retained earnings of 1 lakh. Let's, I guess, go to the additional information. And very clearly, I am given this information in the additional information. On the date of acquisition, beta has got retained earnings, which is appearing to the extent of 80 million. So I think let's come back and do the analysis out here. So we're going to first focus on the retained earnings. So let's take a time scale as we generally do. This is 1st April X0, date of acquisition. And this is 31st March X2, that is balance sheet date. the retained earnings in the balance sheet is given 1 lakh and the retained earnings in terms of thousands at the date of acquisition is 80,000. I think you can very easily calculate what is pre and what is post. This itself is the date of acquisition. So can I say 80,000 becomes pre-acquisition?
Yes, sir.
And
80,000, 20,000 is post.
that's right, 20,000 becomes post. That is pretty simple and straight indeed. So I think one thing is done. Now the focus is only in terms of the fair value adjustments. Let's now go to the next area, and that is the fair value adjustments, for which we need to again focus on the additional information. Let's go back on the additional information, focusing on the fair value adjustments out here. So this last para is focusing on the fair value adjustments. Now be careful, watch this carefully, because I'm going to give you something which is perhaps you're doing for the first time. It says directors of Alpha carried out a fair value exercise to measure the identifiable assets and liability on 1st April X0. So we're given the status of plant and inventory, and very clearly it says that these fair value adjustments are not reflected in the individual financials, but you need to incorporate them in the consolidation, and this will also lead to temporary differences. So we also need to consider the deferred tax implications, considering a tax at the rate of 20%. Okay, let's, I think, begin with first of all the plant and then the inventory. It says plant with a carrying amount of 100 million had an estimated market value of 110 million. And the estimated future, that means the remaining life of the asset is 5 years. And then he also tells you this remains valid. Then he says 20% plant is disposed since the date of acquisition. Now let's organize the data step by step. So I am first coming to the inputs on the plant and machinery. So first of all, I guess let's organize that what is the data for the plant, what is the fair value, and what is the book value. So can I say the fair value is given to me, it is supposed to be 1,10,000 in terms of thousand, and the book value is supposed to be 1 lakh. So I guess undoubtedly you will agree that this 10,000 is supposed to be the fair value adjustments. Now let's do one thing. For the time being, let's forget about any deferred tax implications mentioned in the question. Let's forget about any sale of the plant. Let's concentrate as an ordinary adjustment. So can I say if you've taken the fair value adjustments out here, can I say what do I need to do next is consider the additional depreciation, right?
Yes, sir.
The remaining life of the asset is supposed to be 5 years. So can I say if I consider 5 years, then in this particular case, what will be the depreciation? Can I say
2,000.
2,000? And this
Yes,
is going to be taken for 2 years, correct?
yes, sir.
Because your post-acquisition period is comprising 2 years. So we need an additional depreciation to the extent of 4,000. That's how we've done adjustments earlier. So you took the fair value increase in pre and the additional depreciation in the post. Now watch me carefully. Now watch me carefully and please vouch me very, very carefully. Can I say when you consider the fair value of this asset, for the purposes of Ind AS 12, is the fair value the carrying amount for Ind AS 12? Yes.
Yes, sir.
Because when you have updated the fair value, then you can say for the purposes of your book value or the carrying amount, 1,10,000 becomes the carrying amount. And what is the tax base? The tax authorities will not give you a deduction which is equal to the fair value. They will give you a future depreciation deduction, can I say equal to the book value itself. So for the purposes of Ind AS 12, can I say this becomes the carrying amount and this becomes a tax base? And if the carrying amount is more than the tax base, this will lead to a taxable temporary differences. And that will lead to a deferred tax liability. So
Yes,
let
sir.
me,
Here will come. Deferred tax
yes,
liability.
so let's take the deferred tax implications on this as well. So when you consider the deferred tax implications, we can say this 10,000 itself is a taxable temporary difference. This 10,000 itself is a taxable temporary difference because this is the book value and this is the tax base, and we are given a tax at the rate of 20%. So this will lead to a deferred tax liability to the extent of 2,000. Now, when there is going to be a DTL, the entry is going to be the deferred tax expense debit and a DTL gets a credit. So this is an expense. So this will get reduced from the pre-acquisition column. Got the point? So I've taken the fair value increase, that's a gain, and the deferred tax implications is 2. And trust me, if you've got deferred tax implications, you are supposed to record the revaluation gain net of deferred tax implication. So the pre-acquisition column is going to show the fair value gain as an income and the deferred tax liability as an expense. I hope I'm clear, friends, on this. Then I'll
Yes,
go to
sir.
the great. Now there is another interesting inputs which is given in the question. It says that 20% of the plant is being sold off. So the question is that if 20% of the plant is being sold off, let me now tell you the deferred tax liability created, when will it get reversed? Can I say the deferred tax liability created will get reversed on 2 points? One is when you are going to consider additional depreciation prospectively, and 2, when you go to sell the asset as well. So which means there are 2 factors which will lead to a reversal of a DTL. Because today, if you created a deferred tax liability, its reversal will also happen subsequently. And this reversal is going to happen on account of 2 factors. One factor is that once you are going to sell the asset, reversal will occur. Secondly, when you're going to consider additional depreciation, the reversal will occur. Now, before we consider the reversal, there is another interesting thing before we record the reversal of deferred tax liability. Since 20% of the asset is being sold, the question arises, should you consider a depreciation on the entire asset or should you consider a depreciation only on the 80% asset which is unsold? What do you say?
Only, sir. Only 80 percentage.
Makes complete sense because in this particular case, if 20% is sold, then I would not be considering depreciations on that portion. So 80%. So what we're going to do now? What we're going to do is, first of all, for the 20% asset which is sold, I'm saying for the 20% asset which is sold, what I need to do? I need to basically reverse the gain, which is the fair value gain recorded. So out of this 10,000, this is the fair value gain. Once you sold the asset, we need to consider 20% as a reversal. This is not a reversal of a deferred tax. This is not a reversal of a deferred tax. The moment you record the fair value gain and the item is sold, you need to reverse the fair value gain in the post-acquisition column. That's what I asked you about inventory as well. Even in terms of inventory, if there is a fair value gain, you're going to consider that in pre, and if the inventory is sold, you're going to reverse that fair value gain in the post-acquisition because it should get nullified. So this is 20% of this 10,000 which is supposed to be sold. Now let's consider the implications on the reversal of a DTL. 2 things. Can I say there will be a reversal of DTL on this figure? So we'll take a reversal of 20%, that works out at 400. That is the reversal of DTL. And this depreciation will also lead to a reversal. So we got 4,000 into 80%. So on this 3,200, another 20% reversal, that will be 640. So this is the reversal of DTL. I guess let me just connect the dots once again. Let me connect the dots once again. So we've taken the fair value gain, we've taken the additional depreciation as usual. Now you need to remember, if there are deferred tax implications, number 1, the fair value gain will lead to a DTL if the carrying amount is more than the tax base. So I took the deferred tax implication. Now let's assume there is no sale. I think let's do that on a fresh page to understand this better. Let's create two things for your mind because this will help us to understand the concept very well. By the way, are you doing this adjustments for the first time?
Yes, sir.
Deferred tax implications with the sale?
Yes,
Yes,
sir.
sir.
Wonderful.
Sir,
So
what
now
is the
let's,
date of sale, sir?
sorry,
What is the date of sale of plant and machinery, sir? Date of sale?
it doesn't tell you the exact date. It says it is sold since 1st April X0. So I'm safely assuming that you might have sold it off on 1st April, just a couple of days later because I'm not given the exact date of sale.
Okay, sir.
Okay, so let's consider if there is no sale, let's consider that. And if there is a sale, let's consider that for a clarity of thought. So we've got a pre-acquisition column, we've got a post-acquisition column. Now please vouch me on this. So let's go one by one. If there is no sale, what happens? We're considering a deferred tax implications. So just vouch me on that part. Can I say the fair value increase will enter the pre-acquisition column? That is one. Can I say this will result in a deferred tax liability, which will be a subtraction? Agreed on this part?
Yes, sir.
A fair value increase resulting in a DTL. Next, we are considering number three. Can I say this fair value will lead to additional depreciations out here? This will be a subtraction in the post.
Yes,
And
sir.
number four, this additional depreciation will lead to a reversal of a DTL. So you'll take a 20% on this. That would be a reversal of DTL income. Am I clear on the agenda?
Yes, sir.
Fair value increase with a DTL, that is brackets minus additional depreciation minus, but the reversal of DTL 20% on the additional depreciation is an income. Now let's, I think, go ahead. The same situations we are replicating if there is a sale, let's say 20% portion is sold. So we consider the first one, that is a fair value increase. So the first implications would be same. You consider the fair value increase in this case. You consider the deferred tax liability in this case as a subtraction. Now comes the interesting part. So first we need to consider that 20% is sold and 80% is not sold. So we are going to segregate the 20% portion sold and we're going to segregate the 80% which is not sold. So now let's look at this individually to get better results. Can I say for the 20% which is sold, the 20% which is sold, can I say I will take 20% of this as a reduction, in post? Agreed.
Yes, sir.
And can I say this will also lead to a deferred tax liability reversal? So
Yes,
this
sir.
will also lead to a reversal of a deferred tax liability that's going to create an income. Next, we come to that 80%. Can I say in terms of 80%, you are going to consider additional depreciation. That would be a reduction in the post. And this additional depreciation will also lead to a DTL reversal. So this DTL reversal will also be taken as an income. So this is going to be into 20% and this is going to be into 20%. This is 20%. This is the tax rate, by the way. This is the tax rate. So I hope the position is absolutely clear in terms of what is to be done when there is deferred tax implications with sale. Clear?
Yes, sir. Clear, sir.
Wonderful indeed. Let's now come back. So I think we've taken care of the fair value adjustments of the plant, the fair value gain with the deferred tax, and the 20% sold additional depreciations, 80% depreciations, the deferred tax reversals, and the reversal of the profit, the fair value adjustments, all done. Let's go back to another fair value adjustments given in the question. The next item we are given is inventory. It says inventory is got a carrying amount of 35 million and a market value of 38 million, and this inventory is sold since 1st April. I'm pretty confident now with this inputs you can help me out. So let's, I think, come back to inventory. So you can tell me what should be done in terms of inventory. So I'm looking at the fair value adjustments of the inventory. The fair value of this inventory was 38,000 and the book value of this inventory is 35,000. So there is a fair value gain to the extent of 3. Now tell me, what should I do in terms of this fair value change? This inventory has been completely sold. First of all, I should take, is this a taxable temporary difference? And will this lead to a DTL? Yes.
Yes,
The
sir.
book value is more as compared to the tax base, so this will result in a taxable difference and a DTL. So let me take a 20% DTL on this. This is in the brackets. So this is going to be 20% on based on the tax rate. Now tell me, what do I do in the post acquisition column? If this item is sold, should I reverse it in the post? And should I also consider the reversal of a DTL in the post? Because it has been sold off. Because you can see that even in terms of plant, when the item was sold, I did the reversal or the fair value gain.
Yes, sir.
If this is also sold,
You see,
reverse it.
sir, is fully sold. We have to reverse entirely.
No, it is completely sold. If it is completely sold, then in that case, in the post column. And if it is completely sold, we'll have to reverse this as well. Because of the sale of this inventory, the fair value gain gets reversed in the post column and the deferred tax liability also gets reversed. The creation of the DTL will lead to a reversal on the sale of that inventory.
Yes, sir. Sir. I told that. See, we have to reverse entirely.
Oh, yes, I didn't hear that properly. That's great. So this, I think, takes care of the inputs in terms of the fair value adjustments. I guess there is nothing else. The stock reserve is downstream in nature, so I think this is done. Let's now organize the data. Let's see what is the pre and the post acquisition totals.
Sir, if it is sold, sir, then it is required to show, sir.
Sorry, can you come again, please?
If the all inventory is sold, then it is required to show, sir.
If it is sold, then the owner is required to what?
Then amount is required to show, sir, because nothing, there's no effect of this.
Yes, that's the reason. If it is sold off, that means this amount which was supposed to be, an unrealized gain needs to be reversed off. Because when you've sold the inventory, the profit loss on sale is already recorded in the standalone financial statements as well. Then there is no need to capture this. But the gain arose in terms of pre, the sale took place in terms of post. But at the end of the day, if you take the sum total, it gets nullified. Because whatever is recorded on sale, it'll get finished. So whether it's a fair value gain, it gets reversed. Whether it's a DTL creation, it gets reversed. So sale is the point when the reversals will happen, both for the gain and for the deferred tax. Right?
Okay.
So now let's consider the sum total of this. This is pre. I guess it is coming to 90,400 is the pre column, I guess. And this is going to be 80%, so 3,200. I think this is 13,440, if I'm correct. Okay, just check the figures. I hope this is working well. So this is wonderful indeed. The analysis of the other equity of the subsidiary company is done with the concepts of deferred tax, its reversals, etc. Okay, now we go to the next step, and that is the step number 3 2B. So let me just add on out here. So let's go to the next one. That is step number 2B. So in terms of step number 2B, we need the net assets on date of acquisition. So this is going to be the sum total of the equity share capital plus the other equity, which is pre-acquisition in nature. So let's go back to the balance sheet and let's see what was the equity share capital. I think it was 1 lakh if I remember. And the pre-acquisition equity is just calculated in the analysis. that is 90,400. So I think this works out at 190,400 is step number 2B. Okay, then what's going to be the next step number 3? So what's the status? What's going to be the step number 3 now in this case? Analysis, net assets done. What is the step number 3 now?
Purchase consideration.
That's right, the purchase consideration. Now we need to be very careful indeed, because there are a couple of things which are given on the purchase consideration in the additional information. So let's watch this carefully. So first of all, I guess if I want to look at the purchase consideration, I am first looking at, he is making a mention about the investments out here. This is 263349. Let me note it down. So I am given the investments in the balance sheet. I am given the investments in the balance sheet, that is the balance sheet of company A. So this is supposed to be 263,349. Can I say this will be the investment both in terms of alpha in beta as well as alpha in gamma? Because this is the investments appearing in the balance sheet of the investor. So this should ideally include both the investments, the investment which he made in terms of the subsidiary as well as in terms of the associate. Now let's come to the additional information. It says on 1st April, Alpha acquired 75 million shares in Beta, and Alpha issued 2 shares for every 3 shares in Beta. And the market value is 3.5. So let's, I think, consider this data. So we acquired 75 million shares and we issued 2 for every 3 shares. So let's only concentrate to this stage. So I want to calculate that what is the shares issued. What is the shares issued by Alpha to Beta shareholders? So we acquired a total of 75,000 shares. We issued 2 shares for every 3, and the fair market value of each share was 3.5. So can I say the consideration which is paid in shares is this element? 75,000 shares acquired, 2 shares issued for every 3 at the rate of 3.5. I think this comes to 1,75,000. Then I guess let's come back on the additional information. Alpha will make a deferred cash payment to the shareholders of Beta on March X3, which means 3 years later, which is supposed to be $1 per share acquired. So we're giving a payment of 1 for every 1 share acquired. So how much cash payment are we going to give? What it says that we are going to make a payment of $1 per share. So what is the amount of cash payment we're going to make after 3 years? 75 million shares acquired. So can I say $1 per share? So can I say 75 into 1? 75 million is the amount to be paid, correct?
Yes, sir.
Then he says on 1st April, the incremental rate is 10%. Alpha is included a liability of 61983, approximately in thousands, in respect of this DC. Let's, I think, go ahead. It says this is on March X1. Mind it. He says Alpha included a liability in the statement of financial position as on March X1. The balance sheet given in the question is on March X2, but he has taken the value on March X1. Can I say if it is a DC, it results in unwinding of discount? Can I say he has forgot to unwind for the next 1 more year? Is that correct?
Correct, sir.
Yeah.
So which means that the investments appearing in the balance sheet is incorrect. If you technically ask me, the good idea was to make an extract balance sheet before we start of the question. But nevertheless, we've not done the extract balance sheet. That's okay. So we can rectify this in the retained earnings later. So let's come back on this. So first of all, we can say if you're looking at a deferred consideration, so 75,000 shares, 1 rupee to be paid for every 1 share. And we need to discount this at what rate? 10% was the discount rate, I think.
Yes, sir. It was given 10 percentage.
So this is going to be paid 3 years later. So let's see what is the present value of this deferred consideration. So 75,000 discounted at the rate of 10% for a period of 3 years. I think it's 56349 approximately. 56349. So can I say this is the investment which Alpha acquired in terms of beta? The consideration is paid in shares. The consideration is paid in DC. So this works out at 231,349. That is the purchase consideration. Now let's come back to alpha and gamma as well. So let's see what is the position of alpha and gamma. So let's go back to the additional information. It says as far as alpha's investment in gamma is concerned, it says on the date of incorporation, 40% shares acquired by making a payment of 32 million in cash. So this is 32 million, that means 32,000. So this investment is made at 32,000. Let's just add this up and see what does it come to. Does it match with the investments in the balance sheet? 231 plus 32, it is coming to 263,349. Can I say the investment in the balance sheet gets reconciled? We get the breakup of the investment, which is alpha and beta, as well as alpha and gamma. So this is the investment in totality. Let me, I think, also say something at this stage. Does this mean that there is no outside investments in the balance sheet? Because the investments in the balance sheet of alpha is only alpha and beta and alpha and gamma. Once this figure gets reconciled, let's say the figure was not reconciled, can I say if this figure was more as compared to this particular figure, does it indicate that there could be some outside investments? And
Yes.
that outside investments would appear in the consolidated balance sheet as well. So I think let me also pinpoint that this is also indicating that there is no outside investments. So I think this is another interesting part of the question, reconciling the investments in a balance sheet in the step number 3. Now we've got the complete data in terms of the step number 3 as well.
Yes, sir. It's clear, sir. I thought that the associate figure we can put 32,000 and we can balance a figure we can consider. But this is if when there is a other investment we cannot identify.
Correct. So it's going to be dangerous if I take 32 and take that as a balancing figure. I might get a wrong PC, then my goodwill goes for a toss.
Yeah. Fortunately, in this particular question, there is no other investment.
Correct. Okay, so but I think this reconciliation is also required to identify the presence of the outside investment not. That's the moral of the story. Okay, then we move ahead with the next step. And trust me, if you go step by step, there is not a problem. Now, your terms of every step should further increase. You will be able to easily relate that, okay, this is what needs to be done at each and every step. These are the considerations which you need to keep in mind. So let's now go to the step number 4. So in terms of step 4, we need to calculate the NCI. And it is clearly stated in the question that as far as the NCI is concerned, we need to consider, can I say the NCI, which is supposed to be based on the fair value. So very clearly instructions are given that we need to consider the fair value. Let's go back to the additional information. So let's talk about the fair value increase as well. So I am given about the NCI, I guess, in the note number 2 itself. It is the group policy to value the NCI on the date of acquisition on the fair value. The market value of equity share is $2 and this can be used for the purpose. So what is the number of shares with NCI? I guess there were a total of 1 lakh shares in the balance sheet. And I
25,000.
guess 25,000 shares are with the NCI. Because out of 1 lakh shares, 75% is with the parent. So the remaining 25% is with the NCI. And he gives me the fair value per share. That is 2. So once we multiply this, we get the fair value on the date of acquisition. So this is going to give us the status of the NCI on date of acquisition. And to this, we need to consider what? Can I say one is the share in post-acquisition? So we add the share in post-acquisition profits. So if I consider the share in the post-acquisition profits, can I say that will be available from step number 2A? And I guess that is coming to 13,440. So we take 13,440 into 25%. So this is going to be 13,440 into 25%, the share in post-acquisition profits. This works out at 3,360. Is there anything else to be taken in the calculations of the NCI at this stage? Focus points in terms of NCI, is there anything else to be taken? Goodwill is supposed to be full, and because NCI is taken at a fair value, there is a goodwill impairment also given. Let's go back and see the goodwill impairment figure as well. It says in the end of the note number 2, it says Alpha identified goodwill is impaired by 13 million. Since the goodwill is full, because NCI is a fair value, we also need to consider the goodwill impairment as well. So let's also consider the goodwill impairment, which is to the extent of 13,000 into 25%. That is the goodwill impairment. That comes to 3,250. That's it. So this will give us the calculations of the NCI. I guess that works out at 50110. That is the goodwill impairment in this case. Okay, now we come to the step number 5 as well. Once you come to the step number 5, you start getting a feeling that now the question is going to get completed. But there are a lot of adjustments in terms of step number 6. And of course, the step number 5A as well, because we need investment in associate as well. So let's go to the step number 5 now. That is the calculation of goodwill, or the capital reserve, that is bargain purchase gain, as the case may be. This is completely systematic in nature. I need to consider the purchase consideration already calculated. And to this, we need to add the NCI of acquisition. And then we need to compare this with the net assets on date of acquisition. So with this, we are going to get the goodwill, and anything else which needs to be taken in this case. Anything else to be taken care after the calculation of the goodwill as well?
Impairment.
Yes, sir, we get
that's right.
impairment.
We also need to consider the impairment of the goodwill as well. And the impairment, of course, will be complete figure of 13,000. So now let's organize the input as far as the purchase consideration, step 3. So that is 231,349. This is 231,349. Only alpha in beta, because we're concentrating on the subsidiary, not on the associate as of now. Then NCI on the date of acquisition is very clearly given. That is to the extent of 50,000. So this works out at 281,349. And net assets on the date of acquisition, step number 2B, 190,400. So this will give us the status of goodwill. That's 90,949. And you reduce the goodwill impairment, that works out at 77,949. Right. I hope, friends, you've been able to catch up with this question so far. I don't think so there will be real troubles. The best part is if you go systematic, then I think this question would be sinking well in terms of your chronological orders in the mind, right? Okay. So I believe so. You've got the basic input so far clear, right? Okay, so I guess now let's move further. So step number 5 is done. Now I am going to go to the next step. That is the crucial step. That is step number 5A, first of all, to take care of the associate company as well. So let's go to the step number 5A. Before I go to the step number 6, let's consider the step number 5A, an additional step. This additional step would be required only in situations when you are given an associate company in the question. So let's consider the investment in the associate company. So we're looking at investment in the associate company using the equity method. So can I say for this particular purpose, what I need to do? I need to consider the investments in the balance sheet, or you can take the step number 3, that was 32,000. And what do you need to do? Consider the post-acquisition movements. That's it. So in this particular case now, we need to consider, first of all, the investments at cost. So the investment at cost is to the extent of 32,000. Then I need to consider the post-acquisition changes. I need to consider the post-acquisition changes in this case. So I am just thinking, can I say as I said earlier, that the date of incorporation is the date when the investor got, you can say, significant influence over the associate. So the entire profits in the balance sheet, can I say, is post-acquisition, as mentioned earlier?
Yes, sir.
That's right. So let's, I think, come back. So we can see in the balance sheet of the associate company, there is a retained earnings to the extent of 1 lakh. So can I say this entire 1 lakh rupees represents a post-acquisition earning? And what was the stake in the associate company? 40%.
40%.
That's right. It was 40%. So let's take 40% of this 1 lakh. So we can add the share in post-acquisition profits. So let's add the share in post-acquisition profits. So the share in the post-acquisition profit, this is 1 lakh, and we take 40% of this, that is 40,000. Anything else to be taken care as well? Is there something more which we need to consider? There was a stock reserve which was downstream in nature. Will this also get adjusted in the investment account? Because we will take care of the stock reserve in the calculation of the retained earnings. But am I also supposed to make a reduction of that stock reserve in the investment figure?
Yes, sir.
Yes, undoubtedly. So let's go back to the additional information and let's see what is the status of the intercompany sales. So for this particular purpose, I am given in the question, it says inventory of beta gamma on March X2 included components purchased from alpha downstream. This is at 15 and 12.5 million. So I'm looking at gamma. So alpha sold to gamma 12.5. The markup is 25% on cost, which means 1/4 on cost and 1/5 on sales. Ignore any deferred tax implication. So let's take on 12.5 million. So we can reduce the stock reserve in this particular case. So very carefully now. So 12.5 million would mean, I think, 12,500, is it? Is that correct? Should be 12,500 in terms of million. So the profit is 1/4 on cost, 1/5 on sale. And also remember, since it is a case of an associate company, you need to consider the elimination of the stock reserve to the extent of share of the investor. That is something which becomes unique in terms of Ind AS 28. So we need to consider 40% of this. So that is something which we need to be careful on. The stock reserve will be to the extent of the investor's share. So I guess this works out at 1,000. So this will give us the status of the investments in the balance sheet as per equity method. So I think this is 32 plus another 40 minus 1. 71,000 is the investments, I guess. Wow, so this is done. Now we need to consider the inputs in terms of the step number 6. But before we do the step number 6 in this case, we could see that there is some problem in terms of the borrowings, how alpha is accounted for those borrowings. So I think before we proceed with those borrowings, let's also consider the rectification of that incorrect accounting. So let me do one thing. Let me just come back on the adjustments. Though I think we've taken a couple of adjustments so far, I think this note number 2 is all taken care. I guess we're taking care of the note number 3 and 4 almost. Stock reserve will take it in step 6. I think now my focus mainly is on the note number 5, which is pertaining to the investment. So let's, I think, read and analyze this part before we go to the step number 6 once again. Now, this is again crucial, so watch this very carefully. It says long-term borrowings of Alpha. This is the parent company on 1st April X1. So now let's consider my balance sheet is on 31st March X2 and this borrowing is made on 1st April X1. That means it is made at the beginning of the current year itself. So only 1 year is elapsed since the borrowing is made. So it says the long-term borrowings of Alpha on 1st April is 50 million. Alpha incurred a issue cost. I think this should immediately come to your mind. If there is a TC in terms of a financial liability, what is the treatment of TC for a financial liability at AC?
PL, sir. Charge in PL.
No, we did this so many times. I made charts on financial instruments. It is not FPTPL, it is FL at AC. Remember, in terms of financial assets, TC added to FA, and
Yes,
in
sir. We
terms
need
of
to add it,
liability,
sir.
reduction in FL. So when it says there is a TC of 1 million, can I say this should have got reduced from the initial recognition? The exchange rate is given, which we can take later. Then he says Alpha included this at 60 million in the long-term borrowings. Now let's see. If the amount borrowed is 50 million euro and the rate of exchange is $1.2 a euro, so 50 into 1.2, that becomes 60. Is the treatment done by Alpha correct or is it incorrect in nature? He recorded the financial liability in the books without taking a reduction in the TC. So is the accounting treatment right or is the accounting treatment wrong? He did not consider the issue cost. He simply took 50 million, multiplied it with the
Wrong, sir.
exchange rate, recorded the liability.
Wrong.
Yes, sir.
It is
They
wrong.
need to consider it.
Yes, it is absolutely wrong. And then he says he charged that 1.2 million. What is that 1.2 million? The issue cost into the exchange rate. He charged it to the comprehensive income. So all the treatment done is absolutely incorrect. So basically what he did, the transaction cost related to financial liability charged to the income statement, incorrect. So he should have reduced it from the financial liability. So we'll rectify the errors. This also could have been taken as a part of the extract balance sheet if one desires that before you start the question, you can take care of this in the extract balance sheet as well. Then he says the borrowing requires Alpha to make an annual interest payment of 4 million. The average rate of exchange and the closing rate of exchange is given. It's 1.25. So 4 million of interest and 1.25 rate makes it 5. So you took that 5 million in the comprehensive income. Now the question is, if there is a TC, can I say this will trigger what? We did this in financial instruments. If there is a TC, it will trigger what? I gave you 3 inputs when there is a concept of something which gets triggered. I guess many people forgot that. I told you if there is a premium, if there is a discount, if there is a TC, that triggers what? Hint given.
Yes, sir. We have that the interest rate.
Effective interest rate, that's correct.
Effective
So can
interest
I
rate
say
we
with
need
the
to consider.
absence? Yes. So when he took the interest, which is 4 into the average rate, that means the amount of finance cost calculated is also incorrect in nature. So it says the loan is repayable at an amount of 59 million, which means at a premium. There is a TC, there is a premium. So that leads to effective interest rate 11.1. Other than this, he says no other accounting is done for this loan. So he's done absolutely incorrect accounting for this loan. So it's time to first of all consider what is the correct accounting treatment. So let's come back. Let's, I think, come back. Let's first organize the data before I go to the step number 6 fully. So before I go to the step number 6, which is calculating the other in the consolidated balance sheet, let me, I think, just get a small working note. Let's first organize a small working note on the long-term borrowings. So I'll prefer to make a ledger account, which will give us more insights. So let's get the long-term borrowings ledger account to get the rectification. Now, if you recall, when we did the concept of financial instruments, in that particular case, I'd also given you insight that if there is a foreign currency factor, I said don't get worried on the foreign exchange at that stage. You need to basically make 2 columns and you can take in things later. So right now, I'm going to make this financial liability in a foreign currency itself. And then later, I will take care of the translation rates. As I did this earlier also, if you remember, I did a question on the financial assets. I did a question on the financial liability. Remember, there were 2 questions which were there from the RTP, which was a blend of financial instruments with Index 21. I hope you recall. Okay, so I think let's begin the journey. I guess first of all, we're making a rectified ledger, and this is what we are making in foreign currency itself. We'll take care of the currency factor later. So can I say on 1st April X1, when you borrowed the money, we borrowed a total of 50 million. So that 50 million in terms of thousands is going to mean 50,000. So there is a transaction cost. So that transaction cost will get reduced from the financial liability. So this will become 49,000. Now tell me, friends, what am I supposed to do after this? There is an effective rate of 11.1%. So should I unwind the finance charge at the EIR, which is 11.1%? This is 31st March X2. We'll consider the finance charge. So let's calculate 11.1% on this. So on 49,000, we take 11.1%. That's, I think, 5439. This is calculating the effective interest rate, which is 11.1% on the opening balance. That is 49. Thereafter, we also paid the interest at the end of the year. And I think that was given 4 million. So in terms of thousands, that is 4,000. So you can comfortably get the balancing figure in this particular ledger. So let's see what is the balancing figure. I think this comes to 50349 is the balancing figure. Sorry, 50439. This is going to be 50439. Now remember, this is the amount which is in a foreign currency. So I need to also translate this at a exchange rate as well. So which rate are you going to apply to convert this item? The long-term borrowings, I understand, is a monetary item as per Index 21. So what do you say? Am I supposed to convert this at what rate of exchange? It's a monetary item. So what is the rate at which you're going to convert this monetary item? Okay, I think I'll have to answer that as well. So I guess this is, of course, at a closing rate. The closing rate is given 1.25. So this will also convert this amount in terms of the functional currency of the company. So this is 50439 into 1.25. This comes to 63049 approximately. Now we need to consider the rectification. I'll take care of the rectifications. That's not an issue. Now I think it's turn to go to the step number 6. Brilliant question indeed. As I said, you cannot get all the adjustments in a single question. It can be dangerous. But the idea of doing this question is to open up your minds like anything. Can you see the plethora of standards which are working on this? Super. I remember, when there was a paper which was on GFRS, Global Financial Reporting Standards. I remember there was a wonderful case study which also came in the exams, long time back. And that case study was on a first time adoption of IFRS. And that involved some wonderful kind of adjustments, a visual treat to watch out. Okay, so now let's, I think, concentrate on the step number 6. So tell me, what are the focus points in terms of the step number 6? What are the focus points in terms of the step number 6 as we proceed? I gave you a list of the focus points. So how many focus points in the step number 6? I guess I'll have to manage this question. I think everybody has got scared of this particular question. That was the reason of apprehension. So not doing this kind of complicated questions, because then when you start asking questions, you don't get answers on that. So how many focus points in step number 6, friends? So let's, I think, begin with this. I think I'll just make the step number 6. Let's leave the balance sheet at your end. I think if I'm going to make the balance sheet as well, I'll end up making the balance sheet on my own. So retained earnings, let's go back to the balance sheet and let's see what is the retained earnings of the parent. So retained earnings of the parent company in the balance sheet is 281167. So let's take 281167. This is 281167. Now there are a couple of adjustments. Let me, I think, first connect the dots to you. So first of all, I would say there are 3 focus points, as I'd given you earlier as well. So one is that you need to consider a post-acquisition profits. One is you need to consider the stock reserve, which is downstream in nature. And one is you need to take care of the goodwill impairment. But remember, now when you go to consider the post-acquisition profits, you need to consider subsidiary, associate both. When you go to consider the aspect of stock reserve also, then also you need to consider both. And when you're considering the goodwill impairment, associate does not have a goodwill, but there could be investment impairment. So you need to consider the adjustments for the subsidiary also. You need to consider the adjustments for the associate also. So all these 3 adjustments for both the company. And least we forget, there was also the adjustments of the loan, which also needs to be adjusted in this retained earning. So let's begin one by one. So first of all, we're going to consider the share in post-acquisition profits. So first of all, we're going to consider the share in post-acquisition profits in this case. So if I'm considering the share in post-acquisition profits, we need alpha in beta and we need alpha in gamma. So let's go back to the step number 2A to pick up the figures. So in terms of the step number 2A, the post-acquisition, this is 13,440. And associate, we've already taken in step number 5. That is A. So we've got in step number 5A, that is 40,000. So this is going to be 13,440. And there is a 75% stake. And this was 1 lakh into a 40% stake. That is the share in the post-acquisition earnings. So that comes to a total of 10080. And this works out at 40,000. So one adjustment is done. The share in the post-acquisition profits is taken. Then there is another input to be taken, and that is the stock reserve. So we'll take care of the stock reserve as well for both the companies. It was downstream in nature. So alpha sold to beta and alpha sold to gamma we need to take a reduction of the stock reserves for both the companies in this case. So I guess for this, I need to go back to the additional information. And in the additional information, I am given, it's in note number 4, it says inventory of beta gamma is including the components purchased at 15 million as well as 12.5 million with a markup which is 1/4 on cost and 1/5 on sale. So 15 million. So this is going to be 15 million means it is 15,000. Profit is 1/5 and this was 12,500. We already calculated 1/5. But we also need to consider the share of the investor. This calculation we've already done in terms of the step number 5A when we took the associate calculations. Okay, so now with this, I think let's get the data. This is 3,000, the stock reserve. And this is supposed to be, I guess, 1,000. Right, I guess the two main adjustments are done. Then I think we can take care of the goodwill impairment as well. So let's consider the goodwill impairment, full amount or the parent share. The goodwill impairment, full amount or the parent share. We are going to consider what? The parent share. So that was, I think, 13,000. And we consider the parent share 75%. That works out at 9750. Okay, this is done. The 3 focus adjustments are done, but we are still not done because there is another input which is on the rectification of errors. The loan long-term borrowings needs an adjustment because the carrying value of the long-term loan in the balance sheet is incorrect and we need to rectify the balance. That is one. And least we forget, there was a deferred consideration whose unwinding was not done for 1 year. We'll come back to that. So let's first take care of the loan adjustments. That is the long-term borrowings. So for this purpose, the balance sheet figure should be 63059. But he has taken in the balance sheet a figure which is to the extent of 60,000. So he's taken a figure which is to the extent of 60,000. So what do we do? Plus or minus? There is an increase in the liability in the books of accounts. So can I say this increase will have to be reduced?
Yes, sir, minus.
That's right. It is going to be a minus. And then finally, we are now going to consider the unwinding which is omitted in this case. So we were given the status that the deferred consideration is recorded at 61983 and that is the figure on March X1. So can I say we have not done the unwinding for the current year. So if there is an unwinding, the omission of the unwinding will lead to finance charge in the current year as well. So let's go back and let's also consider the reduction of the finance charge. So I think I can take that figure and 10% on that. So 61983 approximately. 61983, we've got a 10% unwinding. That is 6198 approximately. Wow. So I think this is done. Let's now finally get the balances in the retained earnings as well. Finally, I think we're just left for the consolidated balance sheet. Other than that, everything is done. How do you find the question? I think it's taken us almost around 1.5 hours almost to do this question. Super. How do you find this question, friends? You need to do this by your own hands once. If you need to get a grip on this kind of questions, you need to sit down and do this question by your own hand. Watch out what is done for adjustments. But how do you find the question?
Yes, sir. It is a beautiful question, and each adjustment it has a unique adjustment. I really appreciate it.
Wonderful indeed. So let's take this 281167 plus 10080 plus 40,000, and this is minus 3 and 1 minus 9750, 3049, and 6198. I think it's coming to 308250. Right. So you want me to make the balance sheet as well, or you want to make the balance sheet on your own, as you desire?
Makes sense.
Okay, I'll make the balance sheet as well. Okay, so let's, I think, make the balance sheet also with you. Let's not leave the question incomplete. So I think now let's go to the step number 7. Let's make the consolidated balance sheet also. So for this purpose, I think let's consider the inputs in terms of certain columns. So I'll take the column for the assets. Then you've got the parent, you've got the subsidiary. Associate is not to be taken, but we need adjustments if any. So just to keep a track, so we're taking the balance sheet of alpha beta, not the associate and the total. So I guess let's begin with the inputs. So I need to consider the data. So first of all, we've got a PPE 267 and 190. So we've got a PPE that is 267 and this is 190. We had some fair value adjustments. Now we need to go very, very carefully. Please don't take deferred tax implications in the PPE. So I guess there was a fair value increase, if I rightly remember, 8,000. And then there was an additional depreciation, which was taken, I guess, 3,200, if I rightly remember, right? If you have the notes with you, then I think you recall in the step number 2A, there was a fair value increase of 10, and then there was a fair value decrease of 2 as well. So this is increase and this was decrease on account of sale, and that was the additional depreciation. I think that's it. So this was the input. So this comes to 267 plus 190 plus 10,000 minus 5,200. I think it's 461,800. See if I missed out anything on the fair value changes or everything else is taken. The next item is the investments. Only the investments in associates will appear. So we've got the investments in Gamma. So what was the value of investments in Gamma? In step number 5A, and that is 71,000. So investments in Gamma is appearing at 71,000. Right, so least we forget, let's also consider the goodwill as well. So goodwill is supposed to be, I guess, the goodwill which we had calculated was to the extent of 77,949. That is the goodwill in the balance sheet. Okay, let's keep a track back to the balance sheet again. So PPE is done, investment done. Then we've got inventories 85 and 50. So we've got inventories that is 85 and it is 50. And we've got a stock reserve only for beta, not for gamma. So I think what was the stock reserve? The stock reserve was 3,000. So this will get reduced. So it comes to 85 plus 50 minus 3. That's 132. The next we are given, there is a trade receivable 7540. So we've got trade receivables 75,000 and 45,000. So 75 plus 45, that 20. No intercompany owings on the trade receivable. Okay, so the trade receivables is done. Next, the cash and cash equivalents is 15 and 10. So cash and cash equivalents is supposed to be 15 as well as 10. There's no adjustments, that makes it 25. Deferred tax will be taken care on the liability side. I think that's it. Nothing else is given. So let's see the total of the balance sheet on the asset side. 461,800, 71, 77,949. So this is, I think, 88,749. That is the total of the balance sheet. Okay, so this takes care of the asset side of the balance sheet. Now let's go to the liability side as well. Same formatting continued. So particulars, then the parent, subsidiary, adjustments, and the totals. So A, B, adjustments, and the total. So let's, I think, go to the liability side. Equity share capital is 195. So this is going to be equity share capital, directly putting into the outer column. Then there is going to be retained earnings. And before we forget NCI as well, retained earnings, you can see the step number 6, 308,250. This is 308,250. And as far as the NCI goes, so we've got the calculations of the NCI, that is 50110. 50110. So I think the equity section is done. Now let's go to the next item in the balance sheet. So there is a deferred consideration which is being unwinded for another 1 year. But now this DC is going to become current because there is a 1 year to go. So DC is going to become current. So I think we just have a long-term borrowings. So we'll take the long-term borrowings, then I'll take care of the DC. So long-term borrowings, we had changed the figure. This was changed to, I think, 60 something. The long-term borrowings were changed to 63049. This was 63049. And the long-term borrowings for the subsidiary is 45,000. So this turns out to be 63049 plus 45. That's 108049. That's long-term borrowing. Then I think we can take care of the deferred consideration, which needs another 1 year of unwinding. 61983. This was 61983. Then there is an unwinding of 6198 finance charge. 68181. That is the deferred consideration. Then let's go further. So DC is done, long-term borrowings are done. Now we've got deferred tax liabilities as well, 21199. So we've got, this is going to be current liability. I've written in between, but this is going to be current. Then there is deferred tax liability. So deferred tax liability is 21199. And we're also given this is 10,000. Now, couple of deferred tax liability figures in the analysis. So I think I'll have to look back the analysis for deferred tax figures as well. I'm just trying to recall. There was a DTL of 2,000 and there was a DTL on the inventory as well. I think let's better go to the step number 2. So there was a deferred tax liability of 2 and the inventory also had a deferred tax liability. That was 600, which got reversed, 400 and 640. So on my deferred tax liability, so 2000 and then it was 600, 600 got reversed, 640 got reversed, and 400 got reversed. So this is all in the analysis in step number 2A. So 21199, 10,000, 2000. So this comes to 32 159. I hope the balance sheet gets agreed with all these massive adjustments. Okay, so this is done. I guess next we are given the trades payable 70 and 30. So we give the trades payable that is 70 as well as 30. So this is no intercompany owing. This remains at 1 lakh. Then further in the balance sheet, we are given short-term borrowings 16 and 10. So we're given the short-term borrowings that is 16 and that is 10. That works out at 26. So I guess this should hopefully close the balance sheet of the company. Let's verify this. 195 308250 5011 108049 68181. So this I think works out at 887. Wow, the balance sheet is tallied. So the balance sheet is tallied at 887749. Wonderful, clapping indeed. So we've got the final results of the balance sheet. So how much time did it take us to solve this question? It's almost 1.5 hours plus to solve this question. 15 minutes of reading and spending time in terms of solving this question. Super duper. With this question, I think a massive revision on the consolidation, including the subsidiary associate debts taken care. I've got another question, which is going to be on now the consolidated income statement, which has also got a subsidiary and an associate both blended together. But I think before this, we need to give you a break, right?
Yes,
So this
sir.
is a wonderful question indeed. You must practice this by hand. The ideas, of
Yes.
course, may not come in the exams, of course, but all these adjustments will open up your thought processes, that what kind of adjustments you can get and why do you record these adjustments under which steps. Hope you enjoyed the question. Right, friends. So I think time to give you a quick break, 10, 12 minutes. Then I think we'll start with the consolidated income statement question with you. Please enjoy your break.
Okay, sir. Thank you, sir.
You're welcome. I hope you had a relaxation of mind after this marathon kind of a question. So now we are going to do another question. Of course, not that kind of intensity, what we have done in this case, but it is again a good question which is containing a subsidiary as well as an associate. And we're looking at the concept of making a consolidated income statement. So we already know that in terms of consolidated income statement, there are not much complications in terms of doing that kind of question. So I'm going to directly take you to the question itself on consolidated income statement. So let's, I think, go to the question on a consolidated income statement with you. Let me just, I guess, zoom it to you. Right. I hope this is visible, I guess. Do you want me to zoom it further or this is good to go? Okay, so I think let me just read the question out to you. So we given that H is got 80% ordinary shares in S and 30% ordinary shares in A, which is acquired many years back. Now, if it is acquired many years back, we can definitely make a conclusion that the current year profit is supposed to be completely post-acquisition in nature. Because when you're doing a consolidated income statement, the first focus point is we need to see that is the entire current year post or not. Accordingly, we will consider the months for the consolidation point of view. But since it was acquired many years back, which means entire current year is post. The information given is given to make a consolidated statement of P&L for the year ended 30th June. So we given the individual P&L for holding subsidiary and the associate. Then he says there is no items in the other comprehensive income. And I'm also given that on the date of acquisition, the fair value of the S plant and machinery, which at that time had a remaining life of 10 years, exceeded the carrying amount by 10,000. So can I say this fair value adjustments will lead to an additional depreciation? And this additional depreciation will have to be recorded. And I think the most appropriate head, which seems to be recording this additional depreciation seems to be an administrative expense. So whatever is the additional depreciations because of this particular adjustments will be incorporated in the administrative expense. Then he says during the year S sold goods to H. Can I say if S sold goods to H, it becomes an upstream transaction in nature. So can I say when it is upstream in nature, we need to very carefully take care of this element in the cost of sale. The elimination of the intercompany sale and then the stock reserve needs to be taken in the cost of sale. This is at a margin of 25%. So the profit is 1/4 on, you can say, sales. By the year end, it says 60% of the goods have been sold. So what is the unsold portion is 40%. And we take a stock reserve only on the unsold portion. So this is a point which is relating to the stock reserve. Then he says the group's policy is to measure the NCI using a proportion of the net asset method, which means I'm using PASNA. So this means that the goodwill is supposed to be partial in nature. So if there is going to be any goodwill impairment, it is borne by the parent company only. Then he says the current year goodwill impairment is 1,200 and this should again be taken as a part of the administrative expense. So we're also given the impairment as far as goodwill is concerned. So that would also be taken care. Then he says on 30th June X8, investment in the associate company also stands impaired by 450, out of which the current year impairment is 150. Because in terms of the associate, there is no goodwill impairment because goodwill is always a carrying value of the investment. So what gets impaired in the associate company is basically investment. So the treatment is same. When we are going to consider a one-line consolidation for the associate, we'll take care of this impairment loss as well. Then he says on 1st January X8, H signed a contract to provide a customer with support services for the following 12 months. H received the full fees in advance and recognized this as a revenue. So, can I say this is an incorrect accounting? Because we receive the money on January X8, my financials are closing on June X8. Now, your customer paid the full money in advance. But can I
Yes,
say,
sir.
as per India's 115, I should recognize revenue only for the first 6 months. The next
Yes,
six
sir.
Yes,
months should have been taken as advance. Correct.
Yes, sir.
So I think we'll
that is it.
rectify the sales of the holding company because of this adjustments. So we are required to make a consolidated statement of profit and loss for the year ended 30 June X8. Now, you want me to directly first solve this question, or you want me to first give you a little inputs, a mind mapping in terms of all those adjustments and where
Mind map,
those
sir.
adjustments are taken care of?
Yes, sir. Little mind map.
Undoubtedly, mind map would be required. So let's do one thing before we solve this particular question. Let's, I think, first create a small little mind mapping. Because if you remember in the balance sheet also, I had given you that there are a total of 5 adjustments practically. One is with reference to intercompany owing, one is with reference to stock reserve, one is with reference to the fair value adjustments, then there is goodwill adjustments, and if there is any kind of omissions as well. I guess in terms of associates, you may not see any kind of omissions per se, but I guess we'll basically focus on 4 adjustments: intercompany owings, what do we do? Stock reserve, what do we do? And fair value adjustments, what do we do? And not the goodwill impairment, but in terms of goodwill and investment impairment, what do we do for the subsidiary as well as for the associate? So let's begin with the subsidiary as a focus point. So I'm just creating a summary chart as far as the adjustments related to the consolidated profit and loss is concerned. Now let's focus on the 4 adjustments. Let's get it clear which adjustments is to be taken which place. So let's make a small little summary chart. So I am looking at, first of all, the adjustments, and we're looking at the accounting treatment of these particular adjustments. Typically for the subsidiary, associate of course doesn't bother much, that would be taken care in the question. Now the first adjustment is with reference to intercompany owings. The first adjustment is with reference to intercompany owings. Do you think intercompany owings has got any role to play in terms of a consolidated P&L? Debtors, creditor, the balance sheet items. So can I say if there is any intercompany
No.
owings, it has got no impact on the consolidated P&L, so there is nothing to be done. The second is the concept of stock reserve, which is supposed to be either upstream or it is downstream in nature. Now, this is one thing we need to be careful on. Can I say, as far as the stock reserve is concerned, in the consolidated P&L, irrespective it is upstream or downstream in nature, the treatment is same. So what do we need to do? Let's look at this carefully.
Yes, sir. We need to audit.
Yes, so what we need to do, there is a sales and there is a cost of sale. So what I will do, I will take the sales of the holding and the subsidiary and reduce the intercompany sales from the figure of sales. So whatever sale is made, and remember this intercompany elimination is not to the extent of unsold goods, but the entire goods sold to each other. Similarly, when you take the cost of sales, you take the holding plus subsidiary and again reduce the intercompany sales out of here. This doesn't lead to any effect as such. Because if you're reducing a common figure from the sales and a common figure from the cost of sale, ultimately the impact in terms of the P&L is zero. So what do you need to do? You need to basically add the stock reserve to the cost of sale. And that will automatically lead to the elimination of stock reserve. So whether it is upstream or downstream, just remember the stock reserve is to be added to the cost of sale. Once the cost of sale goes up, the profits automatically will come down. But
Yes,
there
sir.
is another inputs to be watched out. Can I say in the end, when you are going to calculate the NCI share in profits, in the end, the profits of the P&L will be split between what is attributable to the parent and what is attributable to the NCI. So can I say in this stage, do you need to reduce the stock reserve? In the end, when you're going to divide the profits between the parent and NCI? Okay, I think I'll have to remind that as well. So can I say when you calculate the NCI share in profit, you need to definitely reduce the stock reserve, which is upstream in nature. The subsidiary would have earned a profit which is unrealized. So the subsidiary profit includes that unrealized earning. So before you give the share to the NCI, that stock reserve elimination will be done. Next. The third adjustments is pertaining to the fair value adjustments. So are you going to consider a fair value increase, decrease, or are you going to consider the depreciation, additional and reversal of excess depreciation? Fair value increase, decrease is a balance sheet item. So we just need to take care of the additional or the excess depreciation. So
Only
this,
additional and excess you will consider.
yes, absolutely. We'll only consider the reduction of the additional depreciation or add back the excess depreciation if it is a fair value decrease. So we'll add back the excess depreciation or reduce the additional depreciation as the case may be in the relevant expense head. Another question, when you're going to consider this NCI share in profit, I will also reduce the additional depreciation from the profits of the subsidiary in order to get the NCI share in profits as well. That is another important calculation. The total profits of the parent and subsidiary put together is attributable to the parent and attributable to the NCI. So when you take the NCI share, you cannot take the reported profits of the subsidiary. You need to do these rectifications and then give them the share. Then I'm looking at the fourth adjustment, which is on account of goodwill impairment. So can I say, as far as goodwill impairment is concerned, you will of course, book this expense under the relevant head. So you will book this expense under a relevant head. Say, for example, you book it under administration expense because goodwill will generally be considered as an administrative cost. And
Yes.
will this also impact the NCI share in profits? Will you also make a reduction of the goodwill impairment? Are you going to make a reduction of the goodwill impairment here as well?
Yes, yes, sir. When there is actually the full value and the part value is there.
Very good. Absolutely correct. So we'll take care of the impairment here as well, provided it is a full goodwill. Because if it is a partial goodwill, then in that particular case, the reduction is not required. So we will make this adjustments only when the NCI is at a fair value. So I think this takes care of a summary chart of what adjustments are to be taken where. So the only three adjustments, because intercompany owing has got no effect. So if there is a stock reserve, its impact comes in typically the cost of sale. If there is a fair value adjustments, take care of the additional depreciations. If there is goodwill impairment, book that goodwill impairment. But just remember, when you consider the share of NCI in the profits, the reported profits of the subsidiary needs to be rectified and three important adjustments to be taken. Stock reserve if it is upstream, and goodwill impairment if the NCI is at a fair value and there is additional depreciation due to fair value adjustments. Okay. So I think that takes care of the summary chart. Now we are good to come back on the question. So I guess now we can start with the question. Let's have a fair idea. There is an additional depreciation. There is a stock reserve. There is a goodwill impairment and some rectification with reference to the sales of the parent company. So let's begin the journey. So making a consolidated P&L is even more easier as compared to the balance sheet. So let's take a column for particulars. We'll take one column for the holding, one column for the subsidiary, nothing for the associate, because associate again is going to be a one-line consolidation. So we'll take a column for the holding, for the subsidiary, and adjustments, and then the total. So let's consider this is holding, this is subsidiary, this is adjustments, and this is total. So we get the consolidated profit and loss statement. So let's pick up the information one by one. So we've got a revenue which is 5 lakhs and 2 lakhs. So we've got a revenue which is supposed to be 5 lakhs and this is 2 lakhs is the revenue. Now, before we proceed, let's scrutinize the additional information for adjustments, if any. Now, in this particular case, I think let's go one by one. Let's first go to the last information which is given in the question. On January X8, H signed a contract to provide a customer with a support service for the next 12 months. H received the full fees of 30,000 in advance and recognized this as revenue. How much revenue should I have recorded as such? My
Only for
financial year ends on 30th June.
only
Sorry,
15,000, sir.
yes, can I say 15,000 should have been recorded? Because this
yes, sir.
30
Only
is
yes,
received
sir.
for 1 year, but only 6 months have got completed. So what should I do at this stage? Can I say I should reduce
Reduction.
that 15,000 out of revenue?
Yes, sir. We need to reduce 15,000.
Absolutely correct. Let's go back and now take care of the stock reserve. During the year, S sold goods to H for 10,000 at a margin of 25%. Now, first of all, there are two aspects. There has been a sale of 10,000. Once you consider the stock reserve, first you need to eliminate the intercompany sale. I don't care at this stage what is the proportion of goods unsold. My focus is on the intercompany sale, that is 10,000. So first, what we're going to do, we will first of all eliminate this 10,000 from the sales.
Yes, sir. Whether it is sold or unsold, whether it is sold to third party or not, it's not a matter. We need to eliminate
Absolutely
fully.
correct. So when you go to eliminate the intercompany sale, don't get worried on what is sold, unsold. Every amount is to be eliminated in this case. Let's go ahead. So now next we are given there is a margin of 25% and by the end of the year 60% goods are unsold. So let's calculate the stock reserve. Can I say out of 10,000 40% is unsold and the stock reserve is 1/4. So that makes it 1,000. But I think that will take care in the cost of sale. So let's consider the next item, that is cost of sale. I think what we need to do from cost of sales as well, I'm just putting the line, not to mix the figures, eliminate that 10,000 and can I say add that stock reserve of 1,000. So you can see the treatment very clear that we have eliminated 10,000 from the sales and the cost of sale and we have added that stock reserve in the cost of sale. So the next is cost of sale is 1,80,000. So this is 1 lakh and this is 80,000. So I think this takes care of the adjustments on the revenue and the cost of sale. So this is going to be 7 lakh and this is 675. Also, we get the cost of sale. This is 180 and this is minus 10 plus 1, 171. It's a little international question, therefore you can see the GP. So I'm not writing the GP because in India we don't show GP, but I've taken an international question again so you can see the GP. Next, we are considering distribution cost 160 and 20. And I guess there is no adjustments to that. So distribution is 160 and 20. So distribution is 160 and it is 20. There is no adjustment, so that comes out to 180. Next, I am given administration, and I think in terms of administration, I need to take care of two things. One is I need to consider the depreciation, and the other one is, your depreciation could have perhaps been taken in cost of sales also technically, because this is on a machinery and administration would not be machinery. So I think let's do one thing. Let's consider the depreciation in the part of cost of sale, because depreciation would more relate to the cost of sale, not to administration, because this is typically a factory, a plant and machinery. So let's, I think, take that out here. On the date of acquisition, the fair value of the plant had a remaining life, the fair value which at that time exceeded the book value by 10,000 and the life is 10 years. So what will be my additional depreciation? 10,000 by 10,000.
1,000.
Correct. So we will take care of this also out here. So this is my stock reserve and this is my additional depreciation. So let me change that to 172. So I've taken care of the additional depreciation and cost of sale because that seems to be a more appropriate head. Then next we are given the administration expense, and in terms of the administration, so we are given the investment, the figure of goodwill impairment. It says the group policy is to measure the NCI at Pasna. The current year goodwill impairment is 1200. Take it as a part of administration. So 140 plus 40. So this is 140 plus 40. So this is 1,40,000. This is 40,000. And there is a goodwill impairment that is 1200. Let's take it as a part of this head. So this will be 181,200 is the total administrative expense. Okay, so I guess now we need to see what is left over. Additional depreciation done, stock reserve done, goodwill impairment done, investments impairment yet to be taken because we yet to take the associate, and this adjustments advance is done. So I think all the adjustments are done except the investment impairment of the associate. Okay, now let's, I think, take the figure. So we just can calculate the PBT at this stage. So let's take the PBT. So let's calculate the PBT at this particular stage. The profit before tax. 675 minus 172 minus 180 and 181,200. I think it's 141,800 is the profit before tax. Okay. Now I think let's do one thing. Let's also consider the share in the post-acquisition profit. Let me first take the tax expense. Then I can take the share in associate. Whatever is the profit in the post-acquisition, share in the associate. So let's first look at the tax. So tax, we are given 23 and 21, no adjustments. So 23 and 21. So this is 23 and this is 21. So I think this works out at 44 is the tax. Now let's, I think, consider the share in the post-acquisition profits of the associate company as well. So if you look at the associate company status, the associate company earned a profit of 26,000. So can I say we've got a 30% stake? So out of this 26,000, we take a 30% stake. And from that, we need to make a reduction of the investment impairment as well. So let's take 26,000 into 30%. And the investment impairment for the current year, I guess, is 150.
150, yes.
So let me take the workings, 26,000 into 30%, and the investment impairment is 150.
It's 7650.
That's right, 7650 is the share in the post-acquisition. I think this will give us the profit after tax. Let me just see if anything else is still pending. I guess the revenues are taken, the cost is taken, distribution, admin, tax, everything taken, depreciation impact taken, stock reserve taken, impairment of goodwill taken, impairment investment taken, adjustments taken. Superb. So I think this question seems to be too easy as compared to the consolidated balance sheet. Okay, so let's come back and we can get the profit after tax. Then we just need to split this profit between the parent and the NCI. So 141,800 minus 44 plus 7650, I think is 105,450. Right, so this is the profit after tax. Now with this inputs, we need to split this profit. So let me take this profit, 105,450. This is the profit after tax. So this is now the profits which is attributable to. This profit is attributable to, can I say, the parent company and the NCI. So this is attributable to the parent and NCI. We need to get the breakup of this 105450. So quick question to you again at this stage. Are you going to give the share to the NCI in the reported profits of the subsidiary? Or do we need the adjustments, the three, goodwill impairment? If it is NCI fair value, then there is going to be stock reserve, which is upstream, and additional depreciation. So book profits reported or rectified?
Sir, book profit rectified.
Correct. So I need to convert the book profits into the rectified profits, and then we'll calculate the share in the NCI share in the subsidiary. So let's get back to the book earnings first. Can I say the book earnings profit after tax is 39,000? So this is the book profit, that is 39,000. And we need to consider number one, additional depreciation. We need to consider number two, was there a stock reserve which is upstream in nature? We'll see. And number three, we also need to take care of goodwill impairment if fair value. So I think the NCI was taken at Pasna, so goodwill impairment will not be taken. Let's see what was the additional depreciation. That was 1,000. And stock reserve was up or down? It was upstream. So I think we've got two adjustments. 1,000 for depreciation, 1,000 for stock reserve. But goodwill impairment is not adjusted because it was Pasna. So I think that works out at 37,000 is the rectified earnings. So we can take 37,000 rectified earnings into what was the share of the NCI. 80% belongs to the parent, so 20% belongs to the NCI. That works out, I guess, at 7,400. So the balancing figure, yes, the balancing figure belongs to the parent company in this case. Superb. So 105,450 minus 7,400, that works out at 98050. Wow. So I think the consolidated income statement is also taken care. Now we've got another agenda in terms of the standard. If you remember, I told you on consolidation that there are three agendas. One is on the scope and the control assessment. One is on the consolidated financial statements, balance sheet, P&L, and the third is changes in the percentage interest. So we need to see that if there is a change in the ownership interest, what are the permutations combination? Let's, I think, create a mind map to begin with. So let me, I think, first create a mind map on the agenda. That is, there is a change in ownership interest. There is a change in the ownership interest. So I guess let me just create some permutation combinations and let's decide the factor. I'm just going to first make a quick summary chart and then we can do some questions on this area. But let's, I think, first of all, look at a summary chart of how the different permutation combinations could arise. Let's have a look. So I am just making a quick mind map on this area because there are many questions in the study mat which covers the area of changes in ownership interest. I'm looking at two broad situations. One is that you acquire a control. So it's a step acquisition. It's a step acquisition where you acquire a control. So I believe there will be two possibilities when you acquire a control. So I'm looking at the possibility one, that is you acquire a control. So when I say that you acquire a control, can I say there are two possibilities which can arise? Either you are moving from a passive investor to a control, or you're moving from a significant influence to a control. Though if you remember, this is what we have already covered in terms of Ind AS 103. when I gave you that it is a case of step acquisition moving from the case of, let's say, a passive investment 109 to a case of 110. Or it could be a case of a significant influence where you're moving from index 28 and you're moving towards index 110. So there will be two broad cases which we have already covered in this area. So I would say there are two permutations, combinations which can follow. One is a case of conversion from a passive investor. Conversion from a passive investor to a controlled situation. That is one. The other is a situation, significant influence, you convert to a controlled situation. Now, since we've already done this, I am just going to quickly ask you questions and you can vouch me on that particular part. Now, my first question to you. If it is a case of switch over from a passive investment to a control, would you like to tell me if that is the case, which index to which index? Passive to control. I just gave you the numbers.
Sir, is a financial instrument to 110.
Very good.
One.
Index 109 financial instruments to Index 110. So can I say when I would have been under Index 109, I would have taken this equity investments either at FPTPL or at FPTOCI, correct? I gave you that inputs in 103 as well, that the investments could have been taken at FPTPL or FPTOCI. So depending the gain loss upliftment will go to the P&L or OCI. So we can put it like this, that we'll have to uplift. Let's not put it uplift, but we can say this will be revalued. Can I say this will be revalued to fair value? And once you're going to revalue this at a fair value, can I say the gain or loss? The gain or loss will enter either the profit and loss or the other comprehensive income, depending it was FPTPL, or we can say depending it is FPTOCI, correct?
Yes, sir.
And another input which also comes to the mind is that if there was accumulated balance in the OCI, what do you do with that accumulated balance in OCI as well?
Transfer to RE.
Wonderful indeed. So we can say that there is any accumulated balance which is there in terms of SOKI. This is going to be transferred to retained earnings as well. Great. Now let's come to the other one, which is a case of significant influence to a control situation. Can you tell me which index to which index we're going to switch over significant to control?
EAS 28 to 110.
Very good. So it's going to be index 28 and we're going to switch over to index 110. So can I say this is going to be a situation where we are changing from an equity method. We did this in 103 as well. And we said that in this case, we need to again change it, bring it to the fair value, and any gain or loss will be taken where? This will also be revalued at fair value. So can I say if this is going to be revalued at a fair value, where are you going to take the gain or loss on revaluation? We did this in the P&L, Index 103. We've already done that. And if you remember, can I say due to the application of equity method, there would have been some accumulated balances in SOKI as well. Am I right?
Yes, sir.
And what will you do with that accumulated balance in SOKI?
We will move to retained earning.
No. We will have to do a scrutiny. And we'll have to see that what is R goes to the P&L and what is NR goes to the retained earnings.
Yes, sir.
Remember?
If it is yes, sir. R and NR will be there.
Yes,
if it is
so we
R,
will do
it
a
will be just in
scrutiny.
the P&L.
Correct. So we'll do the scrutiny and we'll identify what is NR and what is R. Why don't we do a scrutiny in this particular case? Because it is completely NR. Because when you were applying the concept of FPT OCI as a passive investor, it is completely NR. So the scrutiny doesn't come. In this case, If it is NR, it will be transferred to the retained earnings. And if it is R, it is going to be transferred to the P&L. So this was just a revival at the same place that this is what we have done. This was called step acquisition, acquiring a control. That was a case of a step acquisition. Now there is another case which is coming to my mind, and that is a case where you've got a control and you make a sale or purchase, but the control continues. So the other situation, what I am looking at is the third one, the second one, first of all, then I'll take a third one as well. So here we can say that the control continues. Here we can say that the control continues in this particular case. Now, when I say that the control continues, can I say in this particular case, it could be a further acquisition, 80 to 90, or it could be a disposal, 90 to 80. But the control was there earlier and the control continues now. So there will be two cases out here. So one of the cases is that there is increase in percentage, and one is there is a decrease in percentage. So when you say there is increase in percentage, it is a further acquisition, but you already had a control. And decrease means that there is a disposal, but even post disposal, the control continues. So tell me, what will be the status if there is increase or decrease because of changes in the ownership? The control was there, continues. The control does not discontinue post the acquisition or post the disposal.
Yes, sir. When the controls is increased, which means the NCL will get reduced. When the
Very good.
when the control is decreasing, NCA will increase. So that we
Wonderful
have.
indeed. That's great. So because this is supposed to be a transaction which is within, which is with the shareholders of the company. So just need to change the NCI and any profit loss arising goes directly to equity. So in this particular case, when the control increases, you will debit the NCI and you will credit the bank. And any balancing figure, in this case, gain or loss, is going to be taken directly to equity. That is so key. And if there is a decrease, it's time to increase the NCI. So the bank gets a debit, the NCI gets a credit. And in this particular case, any balancing figure again is going to be taken directly to SOKI, that is equity.
Yeah, so we do it will retaining.
Yes, that's right. Directly in terms of equity, which is in terms of RE, without rooting in the profit and loss statement. Okay, so this is second situation. That is, the control continues on further acquisition or disposal. And then comes the third status where we are looking at the situation that there is a change in status. There is a change in the status, which I would like to create a separate chart on the next slide. So I thought, let's put all the changes in one particular place. Though this is what we covered in 103, but I thought let's put it across. So either it is a case of acquisition moving from one standard to another, or it is a case of a change where you are still within the standard, or this is a case where you go out of Ind AS 110. So let's, I think, create this change in status. So we're looking at the change in the status. Now here my mind is working on a lot of permutations, combinations based on the illustrations which are there in the study mat. So I am thinking there could be an actual disposal, there can be a deemed disposal. If you remember, in the study mat, there is a concept of a deemed disposal as well, where you do not sell any shares as such. But what happens that, due to some other investor taking some kind of actions, my share gets diluted. Maybe he exercises a potential ordinary shares and his stake increases and I lose control and that is called a deemed disposal. So this change in status will be basically dealing with the concept of disposal. And I think if I look at the permutations combination, there can be a case of an actual disposal or there can be a case of a deemed disposal. Now, if it is a case of an actual disposal, then there can be various permutations and combinations. Can I say one combination is from a control, it becomes zero, full disposal. or it could be a partial disposal, conversion to associate, conversion to a passive investor. So we can say there could be either a full disposal or there could be a case of a partial disposal. So when you're looking in terms of a partial disposal, another two permutation combinations could arise. And that is, we can have a situation of a partial disposal again in terms of two factor. So if there is a partial disposal in this particular case, we will have a situation where it converts into associate, where it converts into an associate company. And the other one is that it converts into a passive investor. It converts into a passive investment in this case. So these are the different permutations, combinations which could arise in terms of change in the ownership interest, and that is actual disposal full or a partial disposal or a deemed disposal. So what would be the entries in this case? If you remember, I did not make any distinctions between these combinations. So can I do a common entry for all these permutations, combinations? If you recall this, can I do a common entry for all these permutations and combinations? Yes, of course.
Yes, sir. We
So
need
we
to do
can
it.
say,
We need to reverse it.
wonderful indeed. We're going to do a reversal entry. We're going to do a reversal entry of business combination, that is Indes 103. So we'll do the entry for reversal of 103. So let's have a look at the entry in all these cases. So this is going to be common for all cases. Irrespective any permutation combination arises, it's going to be a common situation for all the permutations and combination. So can I say the entry is bank gets a debit? This will be with the sale proceeds, if any, because in a deemed disposal, there will be no bank money. And can I say then there will be investment gets a debit? Can I say this investment is the retained investment? And this will be taken at a fair value. So we'll take the investment retained at a fair value in this particular case. And next, we will debit the NCI. Can I say this will be the value on date of disposal? So whatever is the value on the date of sale, NCI will get a debit on that value. Then the net assets will get a credit, which is sale, and the goodwill also get, which is again on the date of sale. You can say post impairment is going to be post impairment in this case. So where are you going to take the balancing figure in this entry after this is done? There will be some balancing figure. So the gain or loss in this case will go to SOKI, or will it be taken in the profit and loss account?
Profit and loss account, sir.
That's absolutely correct. Right. So I think this takes care of all the permutation combinations. Now we can see maybe a few questions on this area. Broadly, if you ask me, I would say it's either a case of a reversal of 103, or it is a case of an NCI, or if it is moving from a previous standard, then it's done in 103. So not a very complicated affair. Okay, so I think let's do a question with you. I just need to add a question on this. Let me just add a question on this area. Let's do an interesting question, I think, which is a bigger one indeed. I think the best question which is there in the study material. Let me just organize this first of all. This is the best question available in the study mat on this particular area. Right, friends, I hope the question is visible to you. Right, so I think let's have a read on this question. Let me just, I think, delete a few slides. The things will become a bit heavy. Just give me a second. Right, so let's come back to this. Let's have a look now at this question. This is a question which is in the study material, and you can clearly see the heading. It talks about the loss of control conversion into an associate company. Let's read. It says at the beginning of the current financial year, A holds a 90% equity interest in B. That means it is already a subsidiary. Then he says during the financial year, A sells 70% interest to a third party for a total consideration of 56 crores and consequently loses control. So, what entry are you going to pass in this particular case? NCI 103 reversal entry, which case? Can I say it's a conversion of 90 to 20%? So can I say it would be a case of losing control in this 103 reversal entry, right?
Yes,
Yes,
sir.
sir.
Correct. Then he says at the date of disposal, the fair value of 20% interest retained is 16 crores. This is the investment value retained. The carrying amount of the net assets in the consolidated financial statements on the date of disposal is 60 crores. Then there is further information given. The aforementioned net asset includes the following: investments in debt instruments classified as FPTOCI is 12 crores and the related cumulative fair value gain is 6 crores. So he says the investments are recorded at 12 crores and there is a balance which is there in tab number 3 of SOKI, that is 6 crores. What are you going to do with this cumulative gain? Are we supposed to transfer this entire money to REPNL or are you going to do it on a proportionate basis? Because the disposal is to the extent of 70% of the stake. So are you going to transfer the entire 6 crores in terms of profit and loss or 70%?
70%, sir.
That's absolutely correct because it is a debt investment. So debt investments would be a case of R and that will be transferred to the P&L in this case. Then he says net defined benefit liability is 6 crores. So what is this net defined benefit liability? Is it a case of R or is it a case of NR? Arising on account of Ind AS 19 employee benefit standard. This amount includes a cumulative
NR.
loss of 6 crores on account of remeasurement. Sorry, I missed you. So R or NR?
NR, sir.
That's right. So this is a case of R and this is a case of NR. So let's see further what is given. Then he says investments in equity instruments which is not held for trading. Can I say this is definitely NR? It says of which irrevocable change option of recognizing changes in OCI is taken and the cumulative fair value gains in OCI is given. And then it says net assets of a foreign operation is 20 crores and the cumulative exchange gain is there 8 crores due to translating the financial statements. This is called FCTR. So this is R or NR?
R, sir.
Absolutely, this is going to be a case of R. Then he says in consolidated financial statements, 90% of the cumulative gains in ACD have been taken in the separate components of equity, that is tab 3, and 90% of what is mentioned in B is taken in retained earnings. Because you might be remembering that in terms of Ind AS 19, if there is any remeasurement gain or loss, that remeasurement gain or loss, what is called actuarial gain or loss, does not go to the tab 3 but is merged with the amount of retained earnings or presented as a separate column in tab number 2. And then it says, as required by the Ind AS Schedule 3, the remaining 10% attributable to NCI is included in the carrying amount of the NCI. The carrying amount of NCI is supposed to be 6 crores. What would be the accounting entry for the loss of control in the consolidated financial statements? So I think let's do a couple of entries in this particular case. So we'll first put an entry, organize the data. So can I say, let's put first of all the generic entry, which is the reversal of 103 business combination entry. Then we'll put the figures. So bank gets a debit, investment retained gets a debit, NCI gets a debit, net assets gets a credit, goodwill gets a credit, and any balancing figure is going to be taken in the profit and loss account. So let's organize the information. So what is the value at which investments have been sold? I guess 56 crores we've sold the investments.
Yes, sir.
So the bank figure comes at 56 crores. Then next, I'm also given the NCI just out here. The NCI on date of disposal is 6 crores. So let's take the NCI 6 crores. Then I'm also given the status of the net assets on date of disposal. So I am given the net assets is supposed to be 60 crores and investment retained is 16 crores. Investment
Yeah.
retained is 16 and the net asset is 60. And is there any goodwill information?
No, sir.
No, so I don't think so. We have the information to even compute it. So I think we can safely assume that the goodwill might have got impaired and gone. So nothing to be taken for goodwill. So this is nil. Let's see the balancing figure in this entry.
Balancing 16, 18. 16,
18,
sir. 18, sir.
80. So we're getting a
18.
balancing figure 18. Can I say this is going to be taken to the profit and loss? This is the profit arising on disposal. Now, apart from this, what we need to consider in this particular case is the amounts which are there in terms of those three items. So let's, I think, go back. So we've done the scrutiny in terms of A, B, C, D. So we need to consider these amounts. So can I say the point number A will be taken in P&L? So 6 crores into 70% is 4.2. So let's put the entry for that. So there is going to be OCI debit. And we're going to put this in the profit and loss. That is 4.2 crores. 70% of this money. Next, we are given in the point number B, this is the amount which is NR. So 70% of 3 crores will be how much? 2.1. So this is going to be OCI. Sorry, there will be no entry for this because it is already in the retained earnings. So there will be no entry which will be done with reference to Ind AS 19 employee benefits, because that amount is already in the retained earnings. Then I am given the status of investments in equity. So the cumulative gain is 4 crores. 70% of this would mean 2.8. Where do you transfer this? Where do you transfer this 2.8 crores? It's an equity investments. That's right, retained earnings, because this is supposed to be a case of NR. So this was a case of R. This was already in RE. This was already in the retained earnings. And this is again a case of NR. And then further, we're also given to the point number D. This is again a case of R, that is FCTR. So the cumulative amount is 8 crores. 70% would mean, I guess, 5.6. So we transfer this again to the P&L.
Yes, sir.
That
P&L.
is 5.6. This is again a case of R. I think it's a wonderful question in terms of getting all the scrutiny in terms of OCI. Beautiful question indeed, because this is the only good question, because whenever there is a conversion of a, you can say, control to an associate, all those balances which are there in terms of, you can say, OCI accumulated in tab 3 will need a scrutiny depending upon the fact that if it is a case of R, it goes in the P&L. If it is a case of NR, it goes in RE. And if it is already in RE, then in that particular case, no entries to be done. So I think it gives us a beautiful insight in terms of three factors. R goes to the P&L on scrutiny, NR goes to the retained earnings on scrutiny, and if it is already in RE, and that's only one exception, which is in RE, that is the employee benefits standard. Right, friends. So I think this question is done, and we are, I think, almost done with the things. So we're done with some massive questions on consolidation. I done consolidated balance sheet, consolidated income statement. We got a flair of the associate as well. So what we are going to do tomorrow with you, we are going to pick up questions on Index 28 as well as on Index 111. Because there is one very interesting question on Index 28, which of course, we could not completely do that in the regular sessions as well, which is basically a loss-making associate. And that's a question in the study material as well. So I am definitely planning to do that question tomorrow, because tomorrow we'll finish with our revisions on the consolidation as well. So tomorrow we'll do questions on 111 as well as Index 28. But my sincere request, the question what we have done today, please do it with your hand. I know that kind of intensity of questions may not be confronted in the exams, but I think it's a good idea to do that to get more grip on the concept. Right, friends. So over to you for any questions on your side.
Sir, I would like to need that question, sir. The complication question you have done today morning. I need that question, sir.
I'll upload that question on this will be uploaded on the portal itself. So you'll be able to download the slides and the question is there out there itself.
Okay, fine, sir. That will be great.
Yeah.
So in fact, that question is really, it contains a very good adjustment actually.
Yes, it is superb. It contains some kind of adjustments which are yet to be seen in the exams.
So,
Like,
yeah,
budgeting, what can be the projections if the examiner goes a little beyond, what kind of adjustments can be seen?
yes, sir. If it is come, we can easily solve that because you supported very well on this.
Thank you very much. That's great. That's really nice of you. Right, friends. So do we have actually a 5-7 minutes? But I think I can't really start something new at this stage. So I think if there are no further questions, then I think we'll call it a day. I'm going to see you tomorrow morning for the remaining questions on the consolidation.
Thank you so much, sir. Have a
Thank you very
wonderful
much
day.
indeed. Thank you, all of you. So I'm going to see you tomorrow morning. Thank you very much. Bye bye. Enjoy your day.
Thank you, sir.
Thank you.
Thank you,
Angie,
sir.
thank you.